All right. Hello, everyone. Just gonna let a couple moments here as I see everyone joining in quickly. All right. Well, hello, everyone, and welcome to our panel today, How to Collect in a Downturn, hosted by the Canadian Lenders Association. We have a wonderful group of panelists today and a really interesting discussion moderated by John Castellano, the Vice President of Chapter Law Professional Corp. John's going to take us through a panel discussion, and then we will be accepting questions live. So as a reminder, you can submit questions at any time throughout the discussion, and we'll try to get to as many as we can. And as always, this panel is being recorded and will be emailed out to all of you afterwards. So without any further ado, I'm going to pass it over to you, John, to kick it off.
Fantastic. Thank you, Danielle. Welcome, everybody. Good afternoon. As Danielle mentioned, welcome to the Canadian Lenders Association webinar on how to collect in a downturn. So again, for ease of reference, I am John Castellano, Vice President at Chapter Law Professional Corporation. I'll be your moderator for today. I present to you with a background in receivable management, more specifically experience in collections and debt consolidation. But this is not about me, my favorite color, my favorite hockey team, or my resume. I'm actually very excited to introduce you to our fantastic lineup of panelists with us today. And before we start, I'd like to thank each of those distinguished individuals for their time and the wisdom that they're about to share with us all. So our first panelist today, Andrew Mulroy, VP of Operations at IA Auto Finance. For over 25 years, Andrew has been a highly regarded leader in the credit collections life cycle, specializing in areas of risk, default, and recovery. Much of his time has been spent in the auto finance industry, developing and leading successful collections and customer service teams. Andrew's logical approach and focused strategies on mitigating loss and improving effectiveness and efficiency metrics have earned him high respect amongst his colleagues and team members. Andrew lives in Whitby, Ontario, with his wife, 3 children, his pup Dexter, his 3 cats, and his dreams of becoming a pit master one day, which tells me that we need to host one of these events in his backyard with a giant barbecue. So welcome, Andrew. Our second panelist, Mr. Tony Pampina, SVP of Operations at CBV Collection Services and Frontline Group. Tony is a seasoned executive who has displayed an incredible passion and commitment to the receivable industry for the past 25 years. Tony's experience falls in all areas of receivable management, including operations and business development. His pragmatic management style has been his greatest strength and can be characterized as an outside-the-box thinker who challenges the status quo. Tony has been married for 25 years, congratulations, and is a father of 2. Our third panelist, Mr. Amir Tachkarimi, CEO and co-founder of Lexop, a rapidly growing fintech startup leading the digital transformation of the collection industry. Before co-founding Lexop, Amir was a practicing banking lawyer for several years at renowned firms and the National Bank of Canada. In addition to his professional successes, he is also a published author and has contributed to publications like Doing Business Report by the World Bank Group. So we're very excited to have these speakers today to address our key topic, how to collect in a downturn. To best answer that question, we thought there'd be some value in exploring 4 key areas. The first being what are key identifiers or characteristics of a downturn. So how to pick up on a downturn when one is occurring or even upstream when one is about to occur. How do economic or financial downturns affect the consumers that we deal with on a day-to-day or us as consumers? How does an organization adjust to the downturn and find creative ways to recover losses? And finally, what does the future hold for debt collections and recoveries after the downturn? So as Danielle mentioned, you do have that Q&A box, that function in your Zoom account. You are welcome to ask questions along the way. We will address the questions in the last 15 minutes of our discussion, so we will open it up. But please feel free to continue to ask questions throughout the presentation as they come up. So without further ado, let's jump right in. For the last year or so, I think everybody's familiar with the big words that have been thrown out, inflation, recession, downturn, all thrown around very loosely, but not much time has been spent discussing how to identify a downturn. So for our first topic, as I'm going to open this up to the panel, I'd love to hear from our panelists on what they believe are key indicators of a downturn. So this is open to all panelists, but Tony, since you got one of my favorite teams in the background there, you can go ahead and get started.
Thanks, John. All right, so why don't we start off with what is the definition of an economic downturn? Simple layman terms: falling rate of economic growth and potential recession. Now, the interesting enough, a recession can be defined when we look at the interesting part is that A recession from a growth, potential recession, interesting enough, is that it can be defined as a sustained period of weak or negative growth in real GDP that is accompanied by a significant rise in unemployment rate. Now, here's the oxymoron. So going back to what we talked about, a significant rise in unemployment rate. We're not experiencing a high rise in unemployment rate. Rather, the opposite. We're at all-time unemployment lows, and simply put, people really don't want to work. Now, businesses large and small are facing decline in sales and profits in recession. Now, the economists, they're projecting growth in real GDP is going to slow down to about 3.2% this year, and then 1.1% in 2023, and then ease up and strengthen back potentially to about 1.3, 1.5 in 2024. Now, any lengthened economic uncertainty is going to create a pause for companies to become proactive, to cut costs, including layoffs. They're going to cut costs in capital spending, marketing, and research. You know, what also happens in recessions, and this is what we're here today, it's going to talk about typically curbing credit access. You know, from my business, slowing collections. And what we're seeing today is spurring business bankruptcies and, you know, personal bankruptcies. You know, we talk about, you know, what we're going to see in our opinion, when we talk about, because we're a debt buyer, so we buy paper, we're in for a period of expected negative growth. We're all seeing soaring consumer durables. We're seeing it at the grocery store. And the biggest hurdle we're all facing right now is, you know, a lack of qualified staff. So, you know, I'm starting this off in saying doom and gloom. I'm not saying doom and gloom, but we're really set up for an uncharted territory, and we're going into some murky waters.
I think that's a great way to start us off, actually, Tony. You talked about going into uncharted territory. So it's always a challenge to try and find those key identifiers as it relates to, you know, how do you pick up on a downturn, or what are the characteristics of a downturn? Andrew, what are your thoughts?
Yeah, I tend to agree with a lot of Tony said. You know, unemployment rates are definitely the key that you see in a downturn, and what we're experiencing today is something very different. But nonetheless, we are heading into a downturn because all other indicators are pointing to that. I think another thing that which Tony was talking a little bit about, consumer spending. You know, you start seeing drawbacks in consumer spending. That's going to have a big impact on the economy. The economy starts slowing, GDP starts dropping, and that's it. Now, from my perspective, within the company, within what I control, what I see, you know, we start seeing NSFs, payments start coming back, payments bouncing. We start seeing delinquency rolls starting to increase, and you know, those are all telltale signs that we're heading into something, and we need to get prepared.
Absolutely, good point. Yeah, a lot of synergies there, similarities in terms of what those key identifiers look like between yourself and Tony and your organizations respectively. Amir, what are your thoughts?
I think definitely there's beyond just the traditional accounting indicators, you'll also notice just consumer behavior will change, right? There's a big cut on discretionary spending. You'll see a struggle to service debt, especially unsecured loans, right? Or credit cards, personal loans, auto loan. People will tend to pay their mortgages first before anything that's unsecured. And general worry, you'll see concern about debt, especially taking on additional credit. So these are just more of a behavioral aspects of indicators that you'll be able to notice.
Yeah, that's a great way to sum up that kind of first question there, right? And talking about kind of the consumer journey as it relates to spending and debt and just even general cost of living. So fantastic job already, guys, to start. You've kind of captured or highlighted a lot of what we're going to summarize or spend some time on later on in the discussion. You know, most people assume that downturns are cyclical, and they've proven in the past to be cyclical. But Andrew, I would actually love to know from you, how long do you believe this economic downturn is going to last? Is it similar to the cycle that occurred in 2008?
It's really hard to say and guess at what the length of the downturn will be, because really we're just at the infancy of it. I think it's going to be determined by interest rates and inflation and how those things progress over the coming months. And then to a lesser extent, but an extent as well, supply challenges. When you have those things all occurring, I think that's what's going to drive us into this downturn and potential recession. Typically, a recession lasts about a year. You know, that's what we've seen in past ones. They typically last about a year. but the depression that kind of follows with it can be a lot longer. And if we look back to 2008, the recession lasted about a year, but the depression that followed it lasted about 2.5 years. So we didn't really see a strong rebound until about 2009, late 2009, where things really started to pick up again. My guess, though, if I was a betting man, I was to throw money down on it, which, I guess I'm allowed to do now. We're allowed to go to casinos now. But I would say 12 to 18 months from now, we should start seeing a rebound, and we should start seeing things better, unless something goes completely different. I think to Tony's point, though, uncharted territories, who knows, right? But that would be my guess. With a strong job market that Canada's experiencing right now, I think could improve and help that along its trail a little quicker. But again, I don't know.
Yeah, fair. No, we don't know what we don't know. I think that's essentially how we've been living our lives, kind of the last 2.5 years, I guess 3 years even now. We're still feeling that impact of the shutdowns and the uncertainty around COVID and how to navigate that, personally, and then also even financially and economically. And that's what's kind of led us to this discussion. So I'm glad you mentioned that, there is no set point. So with that being said, talking about the cycle, I'd be interested in knowing from each of you, relative to your organization and the business that you're in, what are key reactive measures that your organization's put into place, especially when you recognize that there were changes in the consumer, changes in payment behavior due to the ongoing downturn. So Andrew, since you kind of left us with those key points, I'd love to hear from you, especially around kind of maybe some hardship program strategies, how you're changing it internally.
So we've always had a very strong hardship program. I'm a firm believer that that's a needed kind of program in any sort of credit or collections environment. You need to make sure that you can help someone where they need that help. So I'm going to rely on the robustness of that program as we have it now. But a key point is the ability to maneuver and to be flexible. And when things start getting tighter, to identify that and maybe move on to something a little bit more pointed or directed. I think it's really important in today's environment that your collectors are open to mitigation plans. We always want payment in full today. That's definitely a talk track that you want your collectors to do, but they have to recognize that maybe some of these things might not be as simple as they were in the past. You've got a lot of pressures coming down from cost of living, prices of gas, getting to work, those sort of things, and just be open to mitigation plans, open to what possibly could happen and what you can do to mitigate that loss. Expect an increase in delinquency. Expect those sort of things. Staff up where you can. Focus on making sure you have the right amount of people. You got to maintain an open communication with your debtors. You got to make sure that you're available there for them. And look for ways to use technology to self-cure. You've got some self-curing going on there. You want to make sure you're not putting resources to those, because you need all the resources. I don't know, you guys are like me. I don't have endless resources. I have a set amount of people that I can use and call on, and I don't want them working cure accounts that are going to self-cure. I want them working the harder ones. So finding a way to identify how a self-cure happens, maybe using technology or using some of the softer collection approaches that enhance that sort of thing. That's kind of where we're going, but it's a day-by-day thing. As we get through this, we'll determine what's needed and move on that.
Yeah, very, very good insight. I appreciate that response. And personally, I appreciate that response because, I think in our everyday lives, not just as it relates to maybe receivables, but just generally as a business, we're moving more towards leveraging resources, like you mentioned, technology, which we'll get to. We're going to take that on with Amir. But I think even the backbone behind the technology to help fuel that technology is really the data, the analytics, the mining to determine how these patterns have changed. Tony, in your line of work and with your group and your organization, you see mass amounts of data, you purchase mass amounts of data, acquire mass amounts of data, and manage it. How are you better using data analytics or mining or data services to put proper measures in place to adjust or be more agile in a downturn?
Yeah, listen, I'll follow Andrew's lead. I could have said just ditto, but the reality is, the agency world had to embrace change. It's a long journey from the way where we used to do collections, right? Super Bowl just ended last week. you know, we had to throw the playbook out the window, right? Demanding payment in full within X days is not the reality anymore. You know, the reality is really recognizing every file is unique, and the objective is to achieve the best possible outcome on that file. You know, when we go back to the pandemic, the start of the pandemic, I remember March 2020, first couple of weeks, it was like crickets. Everyone was terrified. You know, the world was coming to an end, you know, and, you know, then the government started kicking in subsidies, and, you know, there was a little bit of a kickstart, and we started to recognize that the approach of collections that we learned prior to 2020 had to be thrown out. And, you know, going back to what Andrew said, you know, we went into hardship deferral programs. You know, we created campaigns where make a down payment, we'll call you up in 30 to 45 days once we get some clear light, right? So, and then, you know, as subsidies started to kick in, you started to see some stabilization. People started to gain some confidence. You know, unsecured lending and secured lending started to come back around. But now, again, things are starting to tighten up. The confidence, you know, you hear the doom and gloom with inflation rates and, you know, where the CPI is going. You know, now for us, we to try and combat this, we use a multitude of mining sources to try and get intel. See, for us about collections, I always say this: debtors don't discriminate. So at the end of the day, if they owe one bank some money, they're going to owe probably 3 other banks and their landlord and telco. So, you know, the more information you have, the more information you have to try and get yourself at the front of the line, right? So we triage our business, right? We create some type of waterfall where we use a multitude of products, right, and services, right? We flag for property ownership. We do, you know, scrubs for gainful employment. We score accounts. We do deceased and bankruptcy scrubs. You know, the whole goal here is just like the Super Bowl: move the yardsticks down the football field and generate some money and score a touchdown, right? But there has to be forward progression. If it's not, you know, you're never going to get where you need to get to. And that's why having all this knowledge and doing all this data mining, you know, really gets us ahead of the game. And, you know, we've also switched our mindset, right? So collectors have monthly goals, but we've set up monthly payment plan goals. So this way, you know what, we build the future for ourselves and, you know, effectively build an annuity, not on the backs of the individuals that can't go get a $900 payment that can afford a $25 payment. Once you accumulate all these $25 payments, you know, over a period of time, it gets you where you need to get to, albeit slower, but, you know, it avoids what Andrew was saying, all these NSFs, all these uncertain costs. So, you know, that's the approach CBV had to take to try and adjust to the world we live in.
Yeah, I can completely agree with you, even firsthand, you know, acknowledging that the profiling of the consumer or the debtor has significantly changed, and data mining is really what's assisting or aiding in that profiling, which I think is a really good segue into how
I didn't want to use the word
used.
Profiling. That's usually considered a bad word, but that's exactly what you're doing, right?
But that's exactly right. Getting to better understand the consumer, right? Knowing the best approach. Yeah. And I think, you know, that, like I said, this is a perfect segue in better understanding how technology is used to display that information, how to understand that information. So Amir, you know, being a fintech leader and with Lexop, would love to know your thoughts, especially on Tony's comments there around data analytics and leveraging data analytics to leverage technology to make you more effective.
Yeah, absolutely. I mean, you have access to all that data, but ultimately what we say is use technology to provide more TLC, right? So more tender loving care, right? You use technology to be more humane in your collection, even though that sounds very ironic. But ultimately, in a downturn, it's a race against getting paid. So the concept of first to wallet. So use technology to reach and engage your consumers in a better way, because if you stay idle, you'll miss the boat, right? Use an omni-channel experience, use SMS, use email, use them both at the same time. One thing that we say, don't put links in SMSs. People are reluctant to pay in SMS. So these are the concept of how you can leverage technology to be more flexible, to be more digital first, and be able to engage the consumer in the right way, because nowadays people don't even answer phone calls anymore, right? So you want to be able to catch their attention, and ultimately it's all about TLC. That's what we proud.
For sure. And I don't think it's ironic. I mean, we're all people at the end of the day, right? It's a situational change. So it's a matter of how we bounce back from that. I just wanted to take a moment as well. Thank you for the few of you that have sent in questions as it relates to the topic that we're addressing. Again, in the final 15 minutes of the discussion, we will absolutely take some time to address your questions. We continue to use Q&A function on Zoom towards the bottom of your screen. But going back to the topic at hand, appreciate all of you taking some time to share the key identifiers as a business. I think it helps a lot of us become a little more prepared. We're talking a lot about the consumer, right? I've heard, consumer spending has changed, consumer debt has changed somewhat, and then there's the employment factor. So if we could just spend maybe even 1 or 2 minutes each, very high level. Amir, I'd love to understand, especially around the spending piece, because you talked about it a little bit. What do you believe is the actual impact on consumer spending? Are consumers living outside of their means? Is that what's going on? Or consumers prioritizing their finances differently? Would love to know your thoughts around that.
It's very timely because we just did a study that's going to be published soon with thousands of Canadians we surveyed regarding their spending habits. So it's a scoop. So I'll be sharing some data about it. But essentially, the priority for 2023, the majority of consumers have mentioned that they just want to stay afloat, right? 44% saying they're mentioning that just being able to pay their bills is the main priority at the moment, versus 25% who mentioned that they want to repay back actually the loans. So that's a very important notion here. And the other data that we have that I found very interesting was that I think it was over 43% they were using their savings to cover their bills, and they don't have, and 36% said that they wouldn't have enough money to cover the rest, right? So the concern is real, and there's a lot of bill prioritization that's happening at the moment, right? People will pay mortgage first, and then it's followed by utilities, auto loan, credit cards, telco, and lastly is insurance, according to what we have. So it's the spending habits of being prioritized, right? And you want to be, again, what I said was that try to give a lot of TLC so that you can be treated first.
Yeah, no, very, very good. I'm actually very interested to see that study to be completed and actually make it relatable, right, to how, even for myself, how I reprioritize finances as an everyday consumer. And you mentioned, the reprioritization of finances. Mortgage gets paid, and then there's kind of that trickle effect once they hit that wall, that determination that they can't pay certain items after a certain period of time. So Tony, being in your industry, specifically dealing with receivables firsthand, are you seeing a specific type of debt moving into collections more frequently? Is there an influx in arrears? Where are you seeing most of this debt being accrued?
Well, so here's the thing, right? At CBV, we've purchased well over $5 billion in distressed debt over the past 20 plus years. So whether we're in a recession or a peak of an economic cycle, the collection industry is typically seen as a recession-proof industry. All the economists are stating we're in for a wild ride for 2023 with a negative contraction in GDP. So going back to what Amir was just answering with the question here, why is this all happening, right? Because, we just saw the housing bubble, right? In the past 6-12 months, people bought resale homes on the high side of rational, now being forced to pay for a property with negative net equity. Then there's people protesting recently, new home builders who've recently slashed their brochure prices from something they bought 1 or 2 years ago. Used car sales skyrocketed in early 22 to the point, if you bought a car 2 years earlier, you could have sold it for the same price. We believe we're going to see a spike in inventories this year in credit cards, business, and installment loans. But I think there's going to be a larger emphasis in the subprime lending in the automotive sectors, to be honest. But I think it's important not to confuse that increased inventories don't necessarily correlate to increased profits, right? So, personal bankruptcies are on the rise. You see what's happening in the commercial landscape. Commercial bankruptcies are at the highest, with restaurant closings by the dozens. Commercial properties all for lease. The Canadian inflation rate ended in 2022 at a rate of 6.3. That's a far cry from the 3.4 in 2021 and 0.7 in 2020. So, I don't want to, it's going to be a real bumpy ride. And, I was just on a WestJet flight, and just like the cabin steward, right? Stay buckled in till the pilot turns off the seatbelt sign. That's all I can say.
Love the analogy. Bit concerning, but love the analogy. You mentioned there auto finance and potentially an increase in debt load on the auto finance side. I think that's a good segue to you, Andrew, because auto finance debt is increasing, but yet maybe employment rates are changing or consumer spending is changing. Government subsidies have changed. The total savings that even Amir was addressing. Andrew, I'm going to turn to you for a moment here. How has the overall Canadian employment rates, the government subsidies, changed consumer financial behavior and how you manage your receivables? Oh, on mute, Andrew.
My apologies, don't want to make noise in the background there.
No problem.
We all saw in 2020 what happened with the unemployment rate. As soon as COVID hit, the unemployment rate skyrocketed. Like quickly overnight, and then it quickly dropped down like really quick, as opposed to 2008, where it jumped up to 8.5, and then it took the next 5 years before it dropped 2 points. So I think that's a very big difference that you've seen happen. And what we saw though in our industry is we saw payments being made. We saw like performance of our portfolio was much better. Government subsidies really helped that. But I think what helped that even more was the shutdown. The inability to go out to the bar, the inability to go out to movies, to restaurants, and all that. So like the kind of sin stuff. You stayed at home, and staying at home is cheap. So I think that was the biggest thing when it comes to government rates and subsidies and all that's impacted us. As for unemployment, it's been steady through COVID, except for that one spike. It's been pretty steady, and I think it's benefiting us right now. But to Tony's point, it's going to be in the non-prime area. Some of those families that are living with lesser means are squeezed when it comes to servicing their debt due to higher costs of interest rates, and inflation is hurting the food at the table. So those are things that usually come before bill payments and all that. So we're seeing it. Cost of money right now, and like interest rates is probably one of the main drivers of challenges that we have from a profitability perspective.
Yeah, I'm glad you mentioned that last point, the increasing interest rates. And I think, if we take a look back at the subsidies, we talk about, the free money, so free money that was handed out, but also the deferral programs and how that impacted people, right? During COVID, deferring mortgage payments, deferring car payments. And then, we take it back to your point, Amir's point around hitting that wall of affordability, right? What you can afford up to a certain point, but then what happens? So I love the way that this conversation is going, because I think it's so important in these forums. We're all professionals here as participants, as the audience. It's important that we share these best practices, because we're all feeling the same effects of this downturn. So it's important that we remain aligned on these key strategies. So thank you guys for sharing some of your best practices as individuals, but also as a reflection of your organization. I want to turn it to now actually managing the receivables during and post downturn. And that could be a pretty generic or broad topic, but if we keep it specific to some of the key subjects that we've highlighted today, technology and how that's helping you manage your receivables, and leveraging data to manage your receivables, and how even just general collection activity has changed because the type of consumer has changed. Amir, as a tech guru, I'd love to hear how you think we can better leverage existing or new technology to be more effective in managing our receivables.
I think it's important to know your audience, and you mentioned that the change in consumer behavior. Rule number one of collection is to catch the person's attention, right? If you don't do it at the right time, with the right tone, at the right moment, on the right channel, you won't collect, or you won't convert. At the end of the day, it's all about conversion, right? So if you look at collection hasn't changed much in the past 7 years, right? It hasn't been incredible breakthroughs. However, consumers have changed a lot, right? I mentioned it earlier, people don't answer phone calls anymore. People are not receptive to letter mail sent at home, right? You want to be able to solve your situation on your own, on your phone. And there's also the mentality of debt behind it, right? When I'm in collections, when I'm late, I don't feel like talking to someone, right? There's that embarrassment. I want to be able to self-serve, right? So I think it was Tony that mentioned the self-cure option, or was it Andrew? So that's very important. But ultimately, what we see is that if you want to leverage technology, you should see it or consider it in an angle of not necessarily being more efficient in collecting, but being more efficient in retaining your customers, right? It's a retention play, right? That's what we say. At the end of the day, you want to keep those customers so they can come back. Somebody is in collection, it's still a customer, right? So you want to retain instead of write it off as much as possible. I know it kind of hurts you what I'm saying, Tony, but in-house collections, that's what we're trying to do. It's a retention play. So leveraging technology just to be able to catch their attention and bring them towards the payment is very, very important.
And I think you captured it beautifully on that last part, because a lot of it really ties back to segmentation, right? You need to understand what you have. Is there the retention? How many of your consumers or borrowers fall into that kind of retention strategy as you're analyzing your portfolio versus the ones you know that are going to default, and now you kind of have to shift to managing receivables and changing the way that you do interact with that consumer. And I think, again, because I look at these two as hand in hand, that takes it back to understanding the data, right? Understanding the consumer, understanding historical data around your receivables, understanding demographics. So Tony, turning it over to you, based on Amir's comments, how do we better understand payment patterns? How do we find that low-hanging fruit on that receivable side? How do we get those quick wins leveraging data to leverage the technology or the shift or segmentation that Amir was referencing?
Okay, well, let me start off by saying, so we're going to see a spike in volumes, and our biggest concern is the lack of qualified collection professionals in the labor market, right? And so we all have to think outside the box. This is both at collection agencies, credit granted, et cetera. And we all realize that all files can't be treated alike. So a student loan versus a bank credit card versus payday loan all behave differently, right? So, you know, that's where an emphasis has to be played on utilizing scoring models, right? Whether it's tied to a credit or a beacon score from a credit bureau, or for a propensity to pay model that's built on from a credit report, but focuses on whether the debtor can pay a certain dollar value within 90 days. It helps prioritize our accounts. You know, we're putting a huge emphasis and shift in investment into AI. So this goes back to what Amir said. You know, the reality is we're moving into conversational AI as well as omni-channel AI, two-way chats. You know, the reality is, you know, there has to be an element where individuals can resolve things from a voluntary perspective. There's no shame in saying, you know, people don't want to go through dealing with collectors sometimes, right? Whether it's just feeling the effects of objection or embarrassment. So, you know, we've got to put ourselves in a position where, you know, the stereotypes of what collection agencies had maybe 10, 20 years ago is a far cry from where it is today. You know, we're moving forward technical advances, right? We're providing a lot of self-service portals. We want to be able to be, let's call it the price line of collections, right? We want people to come back to us and, you know, provide us the story of, you know, why they are where they are, and we can be credit educators and help them get where they need to get to, right? You know, with us, scoring does play an important role, because when you've got a lot of inventory coming in, you know, and you've got to get to the trough fast enough, how do you do that when you get, you know, listed of 15, 20,000 accounts overnight? You got to be able to identify some levers that are going to help you get to the promised land faster. And, you know, it's not the end all be all. Listen, at the end of the day, someone could win the lottery the night before and all of a sudden have a lot of money, get a windfall from an inheritance. But the reality is, you know, using a triage of scoring and different scoring products, you know, help us get to the promised land a lot faster. Utilizing AI helps provide that confidence where we don't have to have X amount of resources, because going back to what I believe Andrew said, is there's a lot of people that will do the right thing and make payments voluntarily, you know, because if they have the capacity, they will. You know, you saw that during the pandemic. People did what we were surprised to see, pay off their accounts with significant, you know, we've never saw the amount of transactions we achieved at at our place was record. So, you know, you got to incorporate a lot of technology, AI, scoring. You got to triage your portfolios.
Yeah, all very good points. And I think what I picked up on that, Tony, and I appreciate the comments, is there's kind of a consistent theme there, and that is being able to tell a story, right? You're mining the data, you're leveraging scoring, you're leveraging historical transactions to be told a story. And then, you know, taking it back to Amir, in terms of that story, you're leveraging technology to execute on what you found in that story, right? So clear though, in your, it's things have changed. Downturn, managing your best collection practices, how you're segmenting portfolios, you're leveraging different technology. So Andrew, I'm interested now from you in terms of just general collection activity, you know, the general talk off, the general phone call, because now, you know, we have the data that's helping tell us the story. We have the technology that's going to help us execute on the strategy once we understand the story. But what are you doing different in your day to day, and how has that changed based on the changes in consumer behavior and financial circumstances that you guys have been talking about on this panel?
I don't know if it's changed. You know, I've always been a firm believer in the philosophy of collections and you know, being where you need to be and being there for that customer. I think when it comes to the things you want to focus on is you want to maintain an open strategy for communication. You know, you got to be there for that client when they're calling in, whether that's on the phone or it's on the web or if it's an email. You got to make sure you're there and you're responsive. You know, you can't have customers calling in and waiting on hold for 2-3 minutes before they get to an agent to speak with. They're going to hang up, right? They got better things to do, or they got other people calling them looking for money from them too at the same time. My strategy though for this one is a bit of a traditionalist. You know, back to basics. You know, training the agent what to say, when to say it, how to say it, capitalize on the conversation. I would say the hardest part of a collector's job is getting someone on the phone. So making the most of that interaction is so important. So we always are good at telling our agents what not to say, but we're not as good as telling them what to say. And I've always been a firm believer. You want better results, ask better questions. So training your agent, telling them, or helping them identify what they need to do, where they need to ask their questions, what they need to say, you know, those are all key points in building, I think, a strong collection team. Secondly, Tony said it, you got to score your accounts. You got to make sure you're putting your resources where your resources are needed, you know, not where your resources aren't needed. So you're fighting for a piece of the pie, right? So when your agent is talking to a customer, they got to be someone they want to talk to. You know, it's true. Like, consumers have choices, even in the collection field. They have choices of who they're going to pay. A lot of times, I know my experience being an auto lender, you know, if a customer is late on their car payment, they're late on everything. So they have a choice on who they're going to pay, right? And being someone that they want to talk to, you know, having that conversation, you know, is very important, which will increase the likelihood of a collection at that point. To Amir's point, you know, it's that conversion. And that's pretty much it. Like I said, it's back to basics. Training with your staff, ask better questions, those sort of things I think are key.
Yeah, I would agree. And I'm glad you mentioned that point, because as much as we're looking to be more agile in the downturn because of consumer spending changes or changes to financial circumstances, or the overall consumer behavior, or tech has even changed, and how we mine data, or even the data itself has maybe changed. But, you know, it's the basics that you had mentioned are always the table stakes, right? Go back to the table stakes. What are the main key areas or the main key objectives of your organization, and what are the basic steps you need to take to execute on that strategy? Now, with that being said, sure, there are some nuances or variances now that we're in this kind of downturn. And, you know, we talk about prioritization of finances and borrowing credit to pay credit and reorganizing where we put money. But what does the future hold for debt collections and recoveries? Let's assume this downturn is cyclical and, you know, 18 months we're going to start to rebound. But how does that change our future of debt collections? So I'm actually going to open this up as a general discussion to all of you. What do you think will be the main way we engage with borrowers, right? Contact rates, we've talked about that. That's changed. It's much more difficult to get somebody on the phone. Maybe it's because of the prevalence of fraud and spam attempts that we all face day to day, and now we're kind of getting bucketed in there. But how do we improve those contact rates to improve overall recoveries? So I'll leave that open to you guys to have that very fruitful discussion. Amir, if you want to maybe kick it off.
Sure. You mentioned table stakes. I love it. So, what the future holds, we've spoken about it, we've talked about it many times about going digital. I think everybody knows that now. You have to go digital. Everybody's sending emails, everybody going text. One thing that's important, I think, that what the future holds is that if you want to recover better, simple email SMS doesn't work anymore. You have to combine it with the payment experience, right? Just saying that somebody's late is not enough, right? You have to take them by the hand and bring them towards the payment. And I think, Tony mentioned client portals, that's important. But then again, when you go digital, there's that fear of, the concern of phishing concerns, right? So, there's many ways that you can, measures you can put in place to make the experience feel more legitimate, right? Sending an email under your domain name, even the client portal, put a URL that makes sense, right? That the customer recognizes. If you're using a third party and it's their URL, people won't pay, right? They don't even know that relationship with a third party tech provider. So that's very, very important. At the end of the day, it's not about we're not in the email business, right? We're in the conversion business, all of us here. So it's about bringing that legitimate experience that's that's more than email, more than SMS. Right, I think that's what it holds. The whole experience together.
I'll tag along to Amir. He's 100% right. It's about it's an experience, right? No different than when you go to a restaurant, right? You're there for the food, but you're also there for the atmosphere, the ambiance. You want to be able to walk away saying, "I really enjoyed the night," because sometimes you don't get many nights, right? So when you take a look at what Amir said, right? Even when you're running through an AI process of an omni-channel, right? When the payment gets made, respond back, "Thanks for your payment. We'll follow up on this date." You got to hold their feet by the flame. They're in that situation because they weren't that great to follow timelines. So the idea is to make sure that those timelines are kept tight and thanking them. I always say this, from the collection side to it, we used to teach our collectors at the end of every call, if you hear the consumer and debtor say thank you, he's going to pay. Because you made an impression in him and he knows how important it is because you educated him on the ramifications of not paying, right? So the same thing holds true. You have to hold their feet to the flame. And, Amir made a good point. We've seen a dramatic difference. When you send out emails and you got these do not reply at whatever broadcaster domain you're sending, make it personal, right? Blank at CBV Collections is different than do not reply at, I don't know, whatever broadcasting company you use, right? Yeah. It makes it more intimate that someone else is going to respond to you. And we've seen dramatic differences when you start creating little nuances such as that, because you're right. You're fighting for inches on the field, right? And you're fighting for a market share. And it's funny when I use the term market share when you're collecting money, but there's only X amount of money to go around in a debtor's pocketbook. So you want to make sure you prioritize where you can get in front of the line and help him, but help yourself and your client at the same time, right?
Yeah, absolutely.
I couldn't really add anything more to that. I think I think they covered everything. The only thing I would say is mail is dead.
Fair point. Yeah, fair point. I mean, even think about it, even for myself. I don't remember the last time I even checked my own mail. I expect everything via email, right? Or some digital notification, a text notification. And that's, again, all part of the changes or the solutions that as a business, when we talk about receivables, that I think we need to execute on, right? To be more effective. We are running a bit up against time. I'm going to throw out one more quick question. We've got about 2 or 3 minutes here, but I think it's going to spark a really good conversation amongst the panelists, and hopefully the audience agrees. Is it more effective to develop and execute on an internal collection strategy, or is it more effective to outsource it to collection and legal professionals? I'm not going to pinpoint anybody here. I'm going to let whoever jumps in the front of the firing squad go ahead first.
Okay,
I'll take that one.
Who wants to go first?
I'll take that one.
Right.
I'm a firm believer of Both. The answer is definitely both. But it all depends. It depends on your structure, depends on what kind of paper you have, it depends on your volumes. Like if you're a low volume kind of shop, then turn over to the experts and let them handle it. If you're a high volume shop, then it makes sense to start building that expertise in-house. You get when you build that expertise in-house, you get a quicker deployment of strategies. It's easier to change your direction on the fly. But if you don't have those expertise, trying to go out and get them and trying to hire for them, and your volumes and your seasonality is all in place, it's going to cost you a lot of money. So you might want to look at outsource as well. In my opinion, both. I like the idea of outsourcing when volumes are high and bringing in when volumes are low. That's kind of mine.
Yeah, you know what? That would have been my answer. The right answer depends on the size of the organization and the availability of the qualified resources, right? Either way, what's required, internal or external, you just have to have committed tight timelines, right? You got to keep write-offs and write-offs to reasonable ratios, right? Like a reasonable ratio isn't zero. That if you think that your write-offs are zero, give your head a shake, right? But whatever you choose to do, recognize, the worst thing to do is throw good money after bad money. So sometimes the reality is using outside firms where, like CBV or in our industry, where it's based on contingency, you're not throwing good money after bad money, right? You want to establish yourself with a company that has a full service suite, whether it's BPO services, whether it's debt buying opportunities, factoring, or traditional collections. I think anybody or every company has to put an element of also can my outside company, whether it's a law firm or a collection agency, do what's necessary to go after the money that I need to, invest in litigation, right, at very little cost or to no cost, right, with opportunities on getting paid on contingency, right? So, the reality is, it is exactly what Andrew said, right? You need a combination of both. And if you think it's a one size fits all, it's not.
I want to add one more thing is if you do outsource, use more than one, take advantage of that variety.
Sure. Yeah, absolutely. Very good point. Very good point. Amir, any last piece to add to those comments?
No, man, it was good. I echo what they said.
Fantastic. No, that's great, guys. You know what? I think, when we started the conversation today talking about the downturn, it did seem a little doom and gloom. We talk about rising interest rates, cost of goods going up, inflation, not being able to pay, receivables are on the rise. But I think if anything, as participants that are watching or viewing, hopefully you're able to derive some solutions from this conversation, from these distinguished panelists who do deal with this on a day-to-day basis. So I wanted to take this time to thank each of you again as panelists for sharing your insight and your best practices and expertise, and then also thank the participants. As we're running up against time, we do have some questions, so thank you to those that posted in the Q&A. So I'll throw it out randomly, a couple here. What are the best questions you can ask your past due customers? I'll leave that open to the group if anybody wants to take that on.
I think your first question to understand your customer, you got them on the phone, you want to look for a reason for delinquency, because that reason for delinquency is going to really be instrumental when you're providing your solution. If you got a reason for a delinquency that is, accounting hasn't processed my commission payment, that's going to be a very different solution than I lost my job. So first and foremost, you want to understand why your customer has fallen a little bit behind. And I say a little bit behind to avoid that, kind of thing. 45 days is not a little bit behind, but
yeah, you want you want to engage the consumer to believe in providing trust and transparency, right? You can't help someone that's not telling you the truth, right? Like, because remember, in most cases, you're going to have a credit report in front of you, and someone says, I don't have any available credit. Meanwhile, you're looking at their credit report, that, your approach of empathy goes out the window, because now all of a sudden you're not you've already put yourself where there's hidden truths, and it sets yourself back, and everybody gets their self up in arms, and then you decide to take the account in a different direction, right? So you want to be able to have that comfort level where the consumer recognizes when they're providing you a financial capacity, you're really working their best interest, right? Because you just want to get a resolution one way or another.
Absolutely, absolutely. And again, it's consistent with the theme for today, right? Trying to find a way to resolve the account as the environment changes around them, but also as the environment or the access to tools or the changes in payment behavior occur within our own business. So I think you guys put that very, very eloquently. Another question that just popped up, and I think this is, again, being a data and tech background guy, I have a feeling Amir's going to jump in on this one, but when you talk about technology, this is the question. When you talk about technology, many collectors have limited payment options or payment options that continue to get people into debt. Is there a move to more online payment options that are financially inclusive to more people? Question. Love to hear the response on this.
Well, I mean, the idea is to, I shared that study we did last year. It's more and more online payments. That's what people prefer to do. Obviously, we know this. But the idea is that we shouldn't fracture the journey by just imposing people to pay the full amount, right? Maybe within that journey, if I can't pay the full amount, maybe I can make a minimum amount, right? Maybe I can make a payment arrangement. And in fact, I'll start that payment arrangement when I get paid next Thursday, right? So it's more inclusive, it allows more flexibility. And I think there's definitely a move towards that. There's already, key players in the market that do that. And it makes a huge difference, right? Not to fracture the journey by imposing a certain level of payments.
Yeah, I think Amir hit it dead on, right? And the goal here is to provide options and flexibility, right? The old tactical approach is demand payment in full, may not be in the option for most, right? So you got to give people as many opportunities. Like, remember back in the day, John, the only option back in collecting money was Western Union, right?
That's right.
Yep, that was old school, right? So at the end of the day, it's today, it's through self-service portals, it's, online debit cards. There's so many different ways of making payments, right? The reality is you just got to be flexible.
Yeah, I'm glad you brought up the Western Union piece as an example, because you think about it, how far we've come along as it relates to digitization and technology, and we're talking about how to collect in a downturn. I think one thing we cannot forget is that we as consumers ourselves have created this demand for fast, for efficiency, for path of least resistance, for minimal contact. Just make it easy on me. Tell me what I need to do, how to do it through my phone or do it online, and I will do it for the most part. Right. Yeah. If it were that easy, I mean, we wouldn't be having a discussion on how to collect in a downturn. But, I think being mindful that we created that demand, that we want that same efficiency, that same digital experience, and implementing that in our businesses as it relates to receivables, I think will make us much more effective. Yeah. And on that note, it's actually a good segue to another question we got. Do you use or compose with the new platforms? So Facebook, WhatsApp, so essentially kind of the new social media channels. Are any of you guys using that in your day-to-day receivable management practices?
We use it extensively for skip tracing, right? So everyone rushes to, and it's not there for the pictures, right? Like, let's not kid ourselves. Facebook and all these companies don't use it to post pictures of family picnics, right? It's about data mining, right? So the same idea is what we use it for. LinkedIn is great, Facebook. Not so much any of the other social platforms like TikTok or Instagram, right? But the Facebooks of the world and LinkedIn plays a big part in our world. And in many cases finds a lot of low-hanging fruit.
Yeah, we're the same. We use it for that sort of skip tracing methods, and we don't really use it for communication or payment type of messaging.
And I think it really, now with the Canadian Lender Association, we're talking about Canada, but it really depends on your audience too. If you look at South America, everybody communicates via WhatsApp, right? So if you want to catch their attention, don't do it via SMS or email. It's all through WhatsApp. And this is something that we're doing right now in South America at Lexop. But one more thing is that they mentioned skip tracing. When you use SMS, when you use email, you can have a little bit of geolocation if you can have that audit trail capabilities. That can be very interesting as well. But it kind of depends on your audience and what you're looking to do.
For sure. I definitely agree. Definitely agree. I think we're moving more to, again, focusing on those digital channels, two-way communication without actually having to speak to somebody on the phone. No, this was fantastic, guys. I know we're running up against time. I think we got one question that just came in, and we got to thank you. Well, you're very welcome. So we appreciate everybody taking time out of their busy day to join us today for the CLA webinar. Hopefully you were able to take away some of the best practices as you hear from these panelists and the organizations that they represent, and you're able to leverage those practices in your day-to-day to better assist you in managing your receivables or potentially even reducing the amount of receivables. But thank you, Andrew, Tony, Amir, distinct pleasure. Really enjoyed spending time with you guys and having you share your knowledge with us. So thank you very much.
Thank you, John.
Thank you very much.
Thank you so much.